Welcome to HyperChange episode 10. Today we're going to talk about Shake Shack, one of my favorite companies and my favorite burgers. When they filed the IPO a couple years ago, of course I was stoked, read the S1. They were not only are their burgers great, so I think it's a good business, but they're really profitable. They're making a ton of money. They were growing like crazy. The only issue is the stock soared after the IPO. It was priced at like 21, didn't open trading until 47 bucks a share, went to 90 bucks on like absurd hype. It was way overvalued. Now, a couple years later, the business is executed. They've grown into their valuation. Let's start with the history of the company. Originally, there were a little hot dog stand in Madison Square Park in New York City, and it was started by a guy called Danny Meyer, who was running a couple high-end restaurants around the park, let them use the kitchen of these high-end restaurants to help out. Ended up having lines around the block. It's like a huge success. Then in 2004, they decided to revamp the park. Danny Meyer applied. He applied to turn that hot dog cart into like an official restaurant, and that turned into Shake Shack. Originally, they only thought it was going to have one store. The lines around the blocks kept getting longer. They introduced burgers. They realized that this was a concept that they could take and expand like across the country, even across the world. Since then, Shake Shack has been growing nonstop. So like a really cool, kind of humble grassroots beginning story of people just loving their burgers and wanting more. Let's talk about leadership. I think this is a really important part of any company, and Shake Shack in particular has excellent executives. So Danny Meyer, as I mentioned, is their chairman. He founded the company. He's an incredible restaurateur, very well known in the New York food scene for really high-end restaurants. He has a company called Union Square Hospitality Group that runs all these restaurants around the city, really high-end, out of my price range, so I couldn't tell you if they're good or not. The important part of that is he brings that high-end luxury like knowledge of how to make you feel like you're at a luxury restaurant or luxury dining experience into the mainstream with Shake Shack. So Shake Shack is kind of his first foray into packaging all he's learned in luxury restaurants and putting it into this like simple concept that everyone can have that's available to the masses. Very cool. But he's not actually running the day-to-day operations of Shake Shack. He's still the chairman. He still works at Union Square Hospitality Group. He owns a ton of the company, but it's kind of hands-off. The CEO is a guy by the name of Randy Garudi, who was actually working for Danny Meyer forever, and one of his managers at the fancy restaurants that were supplying the hot dog stand. So then he was helping run the hot dog stand while managing one of these fancy restaurants. When they opened Shake Shack full-time, he decided to hop in, became the CEO, hasn't looked back since. He's grown the company with Meyer. They seem like an incredible duo, and both of them have not only just passion for like great food, but they have the experience of the luxury dining industry. I can't stress enough how they are bringing that experience to Shake Shack. So let's talk about the business. The business is pretty simple in all reality. They have stores that are open. They sell burgers, shakes, fries. It's just what you'd expect. They have 114 stores around the world right now. They've been growing like crazy. They were only at 14 stores in 2011, expanding exponentially. And what's interesting about that is they're actually not even close to, in my opinion, scratching the surface of how far this can go. If they keep up making their burgers as good as they are, I think people are going to want them all around the world. And if you look at similar kind of businesses, McDonald's, Starbucks, Chipotle, Panera, even like In-N-Out has almost triple the locations of Shake Shack. Huge room for them to double or even quadruple or triple their store count alone, and that's going to account for a lot of growth. And what makes me so excited about the stock is I think we're really in the early innings. In the US, most of their stores are company owned. They own it, they operate it, they put up the capital, they hire the employees. It's their physical store. But internationally, and this is almost for half their locations overall, about 50 of the 114 total are licensed, franchised. Most of these are abroad or in weird places in the US, so I think it's kind of like strategic where they don't want to build something out themselves. They partner with somebody, get that cash flow. But the counter side to that is it's a lot less profitable. I think they're leaving money on the table by franchising. Additionally, they may be in the future potentially like diluting or hurting their brand because someone who doesn't care as much is running their restaurants. So I'm not a big fan of the franchising strategy. I actually am kind of confused as to why they're doing it, because if you look at the numbers, their franchising business is only on like giving them 6 or 7 million in gross profit, while their core business is giving them 60 million in gross profit. So maybe you want to say that like there's way more overhead with that core business and there's not with a franchise, so it's all profits. But I think even if you look at it and take out all those expenses, the bottom line is you just make more if you own the restaurant because you're not splitting the profit with someone else. This is such a good business. They have such a good concept. Why are they selling out this early? Why are they giving away a piece of the pie to franchisees? I don't get that, but I'm sure there's a reason why. So that's a little interesting tidbit. Franchise or not, I think they're going to hit 500 stores or have the potential to as kind of a conservative milestone in the next 5 or 10 years. They recently have kind of like two big initiatives to change their business or expand and grow. One of them is their app. So they have an app they just launched January 23rd that's very similar to like Starbucks app. You can order ahead, you get points, rewards, you have an account profile. I don't know if it's going to work as well as Starbucks because they don't sell coffee, which has caffeine, which is addictive, that people want every day. They sell burgers, which people are trying to not have every day. I think they're going to execute on the app. They're really good digitally. They have a great website, great social, but will they be able to do a good job in terms of getting people to use the app, have that drive engagement, and really boost numbers? No. I'm way more excited about the breakfast. Shake Shack's only serving for lunch right now and kind of dinner. Okay, lunch and dinner. We'll give them both. If they're open for 3 meals a day, that's 3 opportunities to get revenue when people are eating, and they already have the store. They're already paying rent. They might as well keep it open in the morning, get the workers to show up a little early, train them how to cook eggs, and that's exactly what they did. They have 4 locations where they're beta testing this out. One of them, or I think most of them are in New York City. I went to one of them in Fulton Center with a couple friends. We tried it out. I'm super stoked. I'm going to post that video tonight as well. Me and my friends as consumers experiencing Shake Shack's breakfast, so you can get a sense of what it looks like and see if you think it'll be a success or not, and just kind of like get that first person, like, I'm a New Yorker, I eat bacon, egg, and cheese all the time, so now you can see what I think about Shake Shack's bacon, egg, and cheese. So the breakfast launch is really cool because it's not a lot of incremental cost, and I don't think they've figured it out yet, which is why they're only doing it at 4 stores. And as you'll see in the review, we weren't floored by it. It's not something you'd go out of your way to get like you would for Shake Shack's burgers. However, it's only in 4 stores. They may be working on it and trying to improve the breakfast before rolling it out. Either way, even if I think that if they keep the breakfast as it is today, based on my opinion of it, I think it'll be a needle mover. Sure, it's not as great as the burgers, but it's a really good bacon, egg, and cheese. It's only $4 or $5, depending on if you get 1 or 2 eggs. If you're on the go, if it's convenient, you have a Shake Shack near you, I think it's one of the best breakfasts to get. I'm really excited that they're innovating, continuing to expand their menu, and like this is a really low-hanging fruit and opportunity. Shake Shack has a vision. And they're really building on it. They started with hot dogs and they went to burgers and they did the chicken shack. Now they're doing breakfast. I think they're going to be really good at breakfast, but they haven't nailed it yet. But either way, this is such an exciting development for the stock and the company because it can make their stores, which are already some of the industry's most profitable, even more profitable. Let's talk about Shake Shack's financials. So the company is a growth machine. They grew revenue from $39 million in 2011, on pace to do $354 million in 2017. What's fascinating about Shake Shack, what's better than their burgers is their profitability. They're churning out cash and they're investing so much and expanding at the same time. The fact that they're so profitable is really impressive. They have operating restaurant level margins of 28.8% in Q3. To give you some perspective, Chipotle at its peak in 2014 only had 27.2 restaurant level operating margins. So they're more profitable for every dollar you spend at their restaurant than almost any other fast food chain. That's going to be really important later on as to why I think the stock's cheap. To further put that in perspective, Chipotle's operating margin, or restaurant level margin with the whole E. coli scandal, has dropped to 12.1% in 2016. Shake Shack for 2017 preliminary guidance is 27%. So they're more than twice as profitable as Chipotle, like on a per dollar basis. Now, sure, you might say Chipotle is going to bounce back because of E. coli, but I'm just trying to illustrate the point that Chipotle, even as one of the most profitable restaurants at all time in its prime, was not putting up the same numbers that Shake Shack is. That's impressive. Enough about Chipotle. Let's talk about McDonald's. So this is where I get really excited. McDonald's trades at $108 billion. They're only going to do about $22 billion in revenue this year. That's down 10%. That's 5 times price sales. Shake Shack, which is worth about $1.4 billion, is going to do about $354 million next year, is trading for 4 times 2017 sales. Yup, that is right. Shake Shack is growing, but they are cheaper on a price sales basis than McDonald's. I am pounding the table on that. That is bullshit. I don't know who's pricing it. When I did the research to find this out, I was blown away at that fact. Like, it makes no sense to me. Shake Shack's got 0 debt on its balance sheet. They're pumping out cash. They're killing it. McDonald's has racking up debt on its balance sheet. They have another $26 billion. If you factor that into their valuation, they look even more expensive. They keep piling on debt because they're trying to buy back stock and pay a dividend and prop up the share price. That is going to end in a total disaster. When I dove in, I was like, okay, what am I getting for Shake Shack versus what people are paying for the main burger stock, McDonald's? Floored. Sure, McDonald's is cheaper on a price earnings basis, but that's because Shake Shack's investing and getting so big. I want to look at paying for them for sales, and I would pay a premium for Shake Shack sales because they're growing so much quicker. That's just common sense. McDonald's is going to decline 10% this year, and you're going to tell me they should trade at a premium on a per dollar basis than Shake Shack on revenue? Not a chance. And when you factor in the balance sheet instability, I'm baffled. And this is part of the reason why I think Shake Shack looks cheap. So if you compare it to Chipotle, they're at like 2 point something times sales, so a much lower ratio than Shake Shack, but their profitability and their growth is so much lower that like bang for your buck when you're investing, like what I'm getting, the growth, the upside, the potential. Let's talk about risk. Sure, Shake Shack's doing great now, but there's no doubt their restaurant level operating margins could get hammered in a year just like Chipotle's did, or even overnight if some sort of health food safety like scandal breaks out. With any restaurant stock, that's something to keep in mind. And if like Chipotle is a really interesting case study because we need to look at if their profitability bounces back to where it was before E. coli. So far, they're not even close to that. But we're still kind of like going through the trough. So I want to see if Chipotle can get back its restaurant level margins, even like back over 20, 25. They don't have to hit the 27 they were, but like showing that they can fully recover, almost fully recover from that is going to be very important and something that I think Shake Shack investors should watch as well because they're great now. Shake Shack's killing it now. They have no problems, but that could change, you know, like don't get comfortable in the fact that their brand is perfect right now because I don't think it'll stay that way forever and you have to be prepared to face that as an investor. They take so much care in their supply chain, like they work with these great producers, they have Black Angus beef, no antibiotics in their chicken or beef, like their eggs are free range or something. I don't know, whatever. They're buying really good quality ingredients, so it takes them a little bit more time to set up their supply chain. That's smart. Do not lose that, Shake Shack. I go to your restaurant because the quality's awesome. The ingredients are like top of the line. I think they need to keep that consistency. And I've seen that they're doing it, but they need to keep that level of consistency. It's also a hindrance to growth, you know, like how many like antibiotic-free cows are there? Like they need to go find them every time they build a new restaurant. If their beef is never frozen, they have to make sure they're fresh or like kind of in the same geographic region. So like to every region they expand to, they need to rebuild out their supply chain or a big portion of it. That's why I think we've seen them be a little slower to expand on the West Coast, but it's coming. And when it comes, they're going to do it the right way, even though it takes a little longer. I think that's really smart. The final risk, I guess, is they just can't keep the personal touch. The business gets too big. This is what happens to a lot of restaurants. You know, no one takes care anymore. It's just like a big corporation. They could triple in size, be the size of In-N-Out, and not have that issue. In conclusion, this is one of my favorite restaurant companies. I don't own the stock because I'm broke and I don't have enough. I'm all in Tesla and Jones Soda. But if I had money to invest in a restaurant company, there's no doubt it'd be Shake Shack. I love their burgers. I love their like the experience of going to Shake Shack's epic. Incredibly run company, great management team, hyper profitable. I think this is a very compelling opportunity. HyperChange episode 10. Watch episode 11 where me and my friends try the Shake Shack breakfast